Hello, and welcome to Portfolio Matters, weekly markets checklist, week 182. And again, it's been a very dramatic geopolitical week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Right, so what do we have this week, Keith?
Well, once again, Donald Trump has been busy, so we've got a lot to get through. Before we get going, a quick housekeeping update. So the next one will be in 2 weeks' time, and we're hoping to get back to the bi-weekly schedule. Okay, news. So you'll all have seen the press conference in which Trump and Vance berated Zelensky. And if anyone is in any doubt that the US is withdrawing its support from Europe, I think that doubt is now at an end. So there is yet no deal on Ukraine mineral rights or US support for Ukraine, or indeed an end to the war. Elsewhere, the US announced tariffs of 25% on Canada and Mexico, which are due to start today, the 4th of March. Now, previously, whenever Trump has announced these, they haven't actually come into effect, but we have yet to see any announcement calling them off. So it seems that those tariffs on Mexico and Canada may well come into effect later today. He's also announced an extra 10% tariff on China from the same date. Keir Starmer, the UK Prime Minister, had a meeting with Donald Trump, which went very well. And frankly, I was very impressed with his diplomacy. He played Trump extremely well, I thought. And it appears that the UK is likely to avoid tariffs. However, Trump has threatened the EU with 25% tariffs and claims the bloc was formed to screw the US. So, what's he going to do with tariffs on the EU? Watch this space. The US House of Representatives passed a proposed budget would see 4.5 trillion of tax cuts and 2 trillion of spending cuts over the next decade. And that would include cuts to Medicaid and welfare programs. We have coming up a section on the Byrd Rule and how US budgets are proposed and the constraints on the president. The UK is going to boost its defence spending by 6 billion per annum to try and get towards 2.5% of GDP spent on defence, and that will be funded by cuts to the overseas aid budget. In markets, Nvidia beat forecast, but the share still fell, and crypto crashed and then didn't, because last night Trump announced that the US would establish a crypto reserve, leading to a very sharp rally in crypto prices. We'll take you through it. Elsewhere in Trump land, this week, Elon Musk ordered all federal employees to report 5 things that they did to their superior and to Doge, or face the threat of redundancy. Okay, some charts relating to the news. Well, this was the UN General Assembly, resolution, which aimed to condemn Russian aggression in Ukraine and call for an immediate ceasefire. And the US voted with Russia. Really shocking. So, any doubts we have about where the US is aligning itself, it is no longer with Europe. And the markets had a bad week. And this is the CNN Fear Greed Index, and it swung sharply to extreme fear. Markets are increasingly worried about weak US growth, and we've seen falls in treasury yields, falls in equities. And this is the expectations of the rate cuts for this 2025, and you'll see We've swung very sharply in a few weeks from markets expecting just one to expecting three. And these are the number of executive orders that Donald Trump has signed. It's unprecedented. So the question is, will the courts stop him from doing many of the things he's intending to do, such as the redundancy offers for federal employees? And now pause, take a look. This is all we know about US tariffs so far. This is a really good summary. So 25% tariffs on Canada, 10% on energy are due to start today. Pause, read. And the Tax Foundation is estimating that US tariffs will rise to 17.7% under Trump's second term if he enacts everything that he has said he's going to. Reminder, tariffs are bad for inflation, bad for growth. And if he imposes 25% tariffs on Mexico and Canada, that will be incredibly bad for their economies because almost 80% of their exports go to the US. So if he's chosen targets where he has maximum leverage, well, he's been right. And Nvidia beat forecasts, but the amount by which it's beating forecasts has been falling. And this week has seen a general fall in technology shares. Has the equity market experienced a vibe shift? We will take you through the equity data later. And bottom line, economic uncertainty near record highs. Elon Musk is encouraging Trump to withdraw from NATO. Okay, this week's economic data and summary. UK, stagflation. EU, stagnation. US, with the tariffs coming in, looks like stagflation. Higher tariffs will be inflationary in the short term and will stop the Fed from cutting interest rates. China, stagnation. And on to the UK, Richard.
Hey, Keith. So with that cheerful introduction from Keith, we'll now move on to what's really going on. So UK car production. I mean, UK car production is on a general downward decline, isn't it? And last month, January, was one of the lowest months since COVID.
Yeah. I mean, there are some exceptional items in here. So we've talked previously about how Jaguar have basically stopped all car production while they retool.
Yeah. This shows that since Brexit, the UK car industry has fallen way behind car production in Germany. In fact, in the top 10, excluding China, and there's a very significant drop there.
I know. I was amazed and shocked by this. Actually, 55% drop in car production.
Yeah, it's enormous, isn't it? And even Germany, down 28% as a result of China competition.
Yeah,
largely. So the CBI Distributed Trade Survey was worse than expected in February and is really showing a poor run of data there.
Yeah.
And the Citigroup Economics Price Index is there for you to take a look at and interpret. I find this one impossible to interpret. UK Indeed Postings Index continuing to slowly drop.
Yeah.
UK wage growth really 6.1%. So it's 6%. It's fairly stable at that level.
Yeah. And now, okay. So last week we were talking about how the very high wage growth, it appears inconsistent with the falling job openings.
Yeah.
And there was an article in the FT talking about UK truck drivers. Now, you remember during the pandemic, there was a shortage of truck drivers. And so that has now been solved, but it's been solved by the fact that their wages have gone up by 27%, as opposed to 16% for the average. And one of the reasons behind the higher wage growth is that truck drivers demand a premium over the minimum wage to do their job because it's inconvenient. And so if you raise the minimum wage by 12% this year,
Yeah,
then they're going to demand a premium, otherwise to do a difficult and tedious job.
yeah,
So, the government continually interfering in the labor market
yeah.
to raise the minimum wage is having knock-on effects throughout the labor market and raising wages.
Precisely, precisely. It basically removes the differential. So it's
Yeah.
not just people on a minimum wage, it's the people who are probably anything up to about 30 to 40% above the minimum wage would expect the equivalent pay increase.
Yeah.
And thereafter, the effect will become less and less. So it's a very inflationary policy. I mean, I always thought it was an inflationary policy, actually, but I was proven wrong. Gordon Brown first introduced it, didn't he, 2 decades
Yeah.
ago? And I thought it was going to be inflationary then, and it wasn't. But I guess what happens is it reaches a particular, as it continues to be hiked up, it reaches a particular level where it does become inflationary. I mean,
Absolutely.
it also reflects an underlying problem in the economy, which
Mm.
nobody's keen on solving. So this is the rise in the average advertised salary versus numbers of vacancies, and you can see this. This is actually quite hard to interpret, isn't it?
It
Because
is. Yeah.
yeah, I mean, advertised salaries is doing roughly what you expect it to do, but it doesn't really seem to have much correlation with the
No, it
number of
doesn't. I
vacancies.
mean, the way I interpret this, Richard, is last week we saw that when you looked at the number of vacancies falling by sector,
Yeah,
there were big drops in adverts for bar staff and serving staff. And so
yeah,
I think what's happened is that you've had a big drop in adverts for low paid staff. And so that's increased the average advertised salary for everyone else.
yeah. That's a good point. That could well explain it, Keith. It may also explain what's going on with the Indeed data.
Yeah.
Employers are increasingly not posting a salary, i.e., they're putting out an advert with no salary data on. I'm not sure how effective a strategy that is, actually, personally.
Well, actually, I think so. My other startup, we've been recruiting somebody, and we did exactly this. And actually, it was really effective.
All right.
So it turned out the salaries that people were demanding, were expecting, was substantially lower than what we thought it was.
Okay.
And so
Yeah.
we got actually 3 very good CVs at lower than we
Yeah.
hoped.
That
So
is
that was
interesting.
great.
Yeah. And of course, that means you are actually you're finding out what the market rate is real time as opposed to going off historic data.
Precisely. And actually, this is quite encouraging, I think, because that shows
Yeah.
that employers are testing the market because they think the market's soft.
Yeah. Interesting, Keith. This is showing that the downturn in hiring actually is quite broad based. With teaching actually
Yeah.
is a
This
big
is
outlier there, isn't it?
Yeah, this is like the US, actually. The
Yeah,
government are supporting the labor market.
yeah. And there are more job seekers per vacancy than there have been in the last 2 years, which
Yeah. So
suggests
again, this should
so
bring salaries down.
yeah, slowing of the economy. But of
Yeah.
course, bringing salaries down is very much a lagging thing, isn't it, Keith?
Yeah.
And
That's true.
if the rate of increase of salaries is slowing right down now, then it won't affect the data it'll slowly affect the data each month going forwards.
Yeah.
And this is the recession probabilities in the US, UK, and Europe, which have they reached a trough and are they starting to climb? Possibly. They've definitely reached a trough. Are they starting to climb? Yeah, looks like they may be, doesn't it?
Yeah. But you see, the UK has got the highest one.
The UK raises less in tax than its European peers. Well, that's
Mm.
not. I always find these comparisons. Obviously, this is a valid comparison. It's just showing the data. I always feel the problem with this sort of information is that you don't know what. Just because another country is doing more of it, it doesn't necessarily mean
Yeah.
it's the right thing to do.
No, I completely agree with that. I mean, but the thing is, Italy is actually already raising like 43% of GDP in tax, but it's still running a 6% deficit.
And look at France up there.
Yeah, absolutely. So their government spending is just way too high.
Yeah, and the United States is very low, isn't it, in comparison?
Yeah,
I mean, the United States has all sorts of problems, but
yeah,
being overtaxed as a country isn't
yeah.
one of them.
It could raise taxes if it so chose, but
Yeah. IPO volume in the UK. Well, we sort of had some golden years, didn't we? In 2010 to 2021. Since then, it's fallen off a cliff.
yeah. UK market not doing well. But again, this is because the US market has been extraordinarily strong over this period.
Yeah, and very
And so,
successful in
yeah,
attracting overseas companies to list in the US.
that's because the valuations are so high.
Yeah.
If your UK tech company is going to be valued 3 times higher in the US, then of course it's going to list there. Now,
Yeah.
if the US comes back down to earth, then that could well all reverse.
The UK government plans to increase defence spending to 2.5% of GDP by 2027. That's an additional 6 billion, which it's going to take out of the overseas aid budget.
Yes.
And it's not enough either.
Yeah. Well, I agree with that. But I was struck by how relatively little pushback they got for that, for cutting the overseas aid budget. Previously there would have been a lot of
yeah. I mean, is it Annalise Dodds
yes.
resigned?
Yeah.
That was fair enough. I mean, she's overseas aid minister.
Yeah, that's it. But that's really about it.
Yeah.
Everyone else just accepted that something got to do.
I mean, something has to be done, doesn't it? We can't raise taxes. In my view, raising taxes would be really, really bad for the economy. So the money has to come from somewhere else. And as we've discussed many times before, the UK's electricity is amongst the costliest in Europe and is really damaging for our industrial base, never mind us poor domestic consumers.
Yeah, absolutely. But you notice how domestic prices are not the highest.
Yeah, but industrial are.
Industrial are. That's very bad for our manufacturing base. I
mean, we just need lots and lots of cheap baseload. And then the wind farms and solar farms, they're the icing on the cake. If you want to do it as a sort of statement, a virtue statement, then go ahead and do it. But to try and base the whole of the UK economy on that type of power production is foolish. And I mean, we have projected this, Keith, haven't we? For the last several years, we've been talking about this. The UK faces 900 billion infrastructure spending spree because you have to spend the money if you're going to go electric. I also think there's a lot of road repair, isn't there, and building repair that needs to be done. I don't know whether that's included in these numbers.
I think it is. I think that's the general investment in the UK's infrastructure.
Yeah. So where are British millionaires leaving and going to Chinese millionaires as well? In fact, so obviously this doesn't quite add up, but the United Arab Emirates is a hot destination for millionaires. Why is that, Keith? Because it's hot and sandy.
Well, 0% income tax.
But surely, isn't that? What about quality of life?
Well, this is my problem with this, Richard, in that I think because we have a friend who votes Corbyn as a multimillionaire, but threatens if Labour's came in and Corbyn got elected and raised taxes, he'd leave for Monaco. So, which strikes me as just getting everything wrong. Money is meant to allow you to live the life you want to do, rather than, your life being dictated by money.
Yeah.
You can't take it with you. So what do you think of this? So because we've cut down on non-DOMs, etc., the rules to attract non-DOMs, is that a good or a bad thing?
I think that's a bad thing. I think we want wealthy people in this country because they invest. They spend some, but they form a sort of base of investment. I think it's really important.
Yeah. Well, see, I disagree actually, because I think though, we do want them in this country, absolutely, but I think they should pay a fair amount of tax.
Yeah, I mean, I agree they should pay a fair amount of tax, Keith. I really don't know enough about the subject to know what that fair amount should be. But I do think we should be trying to get them to stay here.
No, I agree with that.
So therefore the tax rate needs to be set at a level that they consider to be reasonable. So awful April. This is a projection.
No, yeah, well,
Gosh,
have
I
a
look at
read.
Southern Water. Water bills go up 40% by Southern Water. I mean, Thames water bills are going up fantastically on. I don't know
Yeah,
what
31%, I believe, from memory.
Off-gem price cap up 6.4%. Local authorities permitted maximum raise. They're all going to go for that. But effectively, it's 5%.
Yeah,
Car tax up by 2.5% with EVs no longer exempt. I mean, I think it's absolutely right that EVs should be no longer exempt. I'm sure I'll get
I
a lot of
agree.
pushback, but they use the roads, so of course they should be paying a fair share of car tax. And in fact, all cars should pay a flat rate of car tax because they all cause the same amount of wear and tear, roughly speaking. Broadband and phone and TV licenses 7.5%, 3%, and stamp duty will start at 125k. So basically, why are we not going to continue to have high levels of inflation in this country? Just on the water, I mean, basically the water company has been eviscerated by private equity and by overseas wealth funds particularly. And having been eviscerated, the consumer is now putting more money in to try and maintain the services, but the process of evisceration hasn't been stopped as far as I can tell. And so basically the consumer is being the sap to continue to fund obscene levels of profiteering.
Yeah, failure of regulation actually should not have allowed these companies to pile up so much debt.
Yeah, and that's all they need to do. You can't maximize a maximum level of dividends, and you can't take out more debt.
Yeah,
the debt has to be paid down. It's not difficult.
Yeah. So, bottom line, coming your way, if you live in the UK, are a whole load of inflationary, above inflationary, um, tax and bill rises. Now, the thing is, this will be deflationary if there is no compensating rise in wages because it takes money out of people's pockets and away from consumption. The danger is if workers demand compensating wage increases, which they could well do, then you get into an inflationary spiral. And that, frankly, is what we've seen so far. So, not good under any circumstances.
So, gosh, look, in 4 years, the price of the all-you-can-eat buffet in Camden has risen from £8 to £15, £9, 70% rise. And that is the true level of inflation that we're experiencing in many cases, not the much lower level that is publicised by the government and Bank of England in their data.
Yeah, I was absolutely shocked by this, actually. It's quite near me.
Yeah. But you notice it when you go out and you spend money at the supermarket or whatever.
Yeah,
our supermarket bill out last week for the two of us was £168, and it used to be, not a weekly order, it's about once every fortnight, but it used to be 90 quid. Doom and gloom.
Doom and gloom. Okay, thank you, Richard.
How do you get to the United Arab Emirates, Keith? What's the best way of moving there?
I actually lived there in my teenage years.
Oh, right.
And I would not be recommending it, frankly. In the summer, it is 45 degrees in the shade, above 50 in direct sunlight, and you scuttle between air conditioned skyscrapers. And it really is, half an hour outside in direct sun, you'll get sunburnt. Yeah. If you leave your car outside, and you do, then the sun is so strong it will degrade the plastic of your what's the front and the dashboard, etc., etc. It's just, not funny. I wouldn't be, I can see absolutely no attraction to living there. However, I should say all my data is like literally 30 years old. So perhaps it's much nicer than it was.
It's hotter there now.
Yeah, well, that's true. Anyway, on to the EU. So, good news. Negotiated wage inflation came in quite soft, actually, down up 4.1% year on year in Q4, well below expectations. Loans to companies year on year, 2%, weak, but better than expected. Loans to households, 1.3%, better than expected, but again, weak. Money supply, 3.6%, below expectations, but actually okay. Economic sentiment, amazingly improved given everything that's happening in the world economy and the threat of sanctions, or sorry, the threat of tariffs from Donald Trump. But services sentiment faded to 6.2, still positive, but still weak. Industrial sentiment recovered, but that's still poor. Consumer confidence, amazingly improved. Still poor, but better. The bad news is selling price expectations from firms continue to rise. That's inflation. Consumer inflation expectations were higher than expected and are not coming down. Citigroup Economic Surprise Index is net positive over the past week, but job postings in Germany continue to fall. Wage growth in Germany is decent. Actually, that's compatible with 2% target. French, indeed, job postings continuing to fall. French wage growth very weak. Now, the ECB is increasingly confident that wage growth will fall sharply in the coming year and will be back and absolutely compatible with the 2% target. But I thought this was an amazing chart. This is the unemployment rate in Greece. So, post GFC and post the Greek financial crisis, it peaked at amazing 28%. It's now fallen to below the pre-GFC level at 9.5%. So the classical economists will say that economies are self-normalizing and you should leave them alone, and eventually the employment rate will come down. Keynes would say that in the long run, we're all dead. And the fact it's taken 12 years has caused an immense amount of economic and social pain in Greece that could have been avoided if the economy had been better managed. So, in summary, the EU economy is stuck in a low growth rut. Inflation increasingly looks under control, but the EU is under threat of tariffs from the US, which would be very bad for growth, and it needs to increase its defense spending. So how's it going to do that? On to the US, Richard.
Thanks, Keith. So GDP growth quarter on quarter, 2.3%, in line with expectations. PCE inflation quarter on quarter, continuing to increase 2.4%, a little bit ahead of expectations.
Yes, so I should explain that these are the second estimates. So they've revised up inflation in Q4.
And quarter on quarter annualized is at 2.7% quarter four.
Yeah, so much, much better than the UK.
Yeah.
Frankly.
And PC inflation month on month, 0.3%, in line with expectations. PC inflation year on year, 2.5%, again in line with expectations. PC inflation month on month, 0.3%, in line with expectations.
That's core.
And core PC inflation year on year, 2.6%, down from December and in line with expectations.
And that's good news.
Yeah. Personal income month on month, up 0.9% in January, much better than expectations.
Yes, part of that's dividends.
And personal spending month on month, actually down 0.2% in January, which is worse than expectations.
Yeah.
Maybe so. Durable goods orders month on month was up 3.1% in January, but revised down in December. And Chicago National Activity Index down 0.3%, 0.3 in January. And that is worse, significantly worse than expectations.
So on the durable goods orders, I wonder how much of that is businesses trying to get ahead of tariffs, so stockpiling.
Yeah. I'm sure there's a chunk of that, isn't there, Keith? I'm sure you're right. So, Case-Shiller house prices month on month fell in December, but year on year they rose in December to 4.5%.
Yeah, we've got a section on US housing coming up.
And the Conference Board Consumer Confidence Index 98.3 in February, which is significantly below expectations.
Yeah, so the Trump bounce is absolutely unwound.
US trade balance in January was 153 billion negative, much worse than expectations, and actually much worse than it's been. And as Keith says, this may well be due to people trying to get goods in before tariffs strike.
Yeah, I think that's absolutely what's happening.
New home sales are worse than expectations at 660,000 in January.
But still decent enough number, frankly.
Yeah. And initial jobless claims were 242,000 this week, so higher than expected, and at the sort of top end of the recent ranges.
Yeah.
Continuing jobless claims, 1.8 million, nothing remarkable there.
So there's a lag between continuing jobless claims and initial jobless claims. Obviously, in order to be included in continuous jobless claims, you need to have claimed for at least a week. So the spike in initial jobless claims will not start appearing until next week.
Unemployment claims in Washington, D.C. beginning to rise. We would expect this with a lot of redundancies being made from government employees. And this is the federal government employees' unemployed insurance claims. And initial claims actually haven't risen.
Not really very elevated. I mean, the question is, how are they doing this? I think a lot of these, they're saying you will be made redundant, go home, but they're not actually made them redundant yet.
Yeah. And the District of Columbia, the initial jobless claims by week for each year overlaid, and you can see that which is the 2025 is a thick green line.
It's the thick blue line.
It's blue, is it? I am slightly blue-green colorblind, Keith, so I struggle with these. I can see it as a thick line, though.
Yeah.
So we have to wait and see where it goes now, don't we?
Yeah. You see, the thing is, these are not big numbers. 2,000, it's trivial.
Yeah.
But clearly, something is happening.
And if DOGE wants to cut the size of the federal government, it needs to cut defense and veterans affairs, which are the huge, huge ones, and maybe a chunk of homeland security.
Because the things they're cutting, like Department of the Interior, they're not very large.
No. Most of the jobs growth experienced by the US, as we have commented on past, have been in government-funded posts such as education and health. And then that jobs growth needs to come down significantly, presumably. And watch this space really to see how successful they are. And,
job openings data comes out this week. Non-farm payrolls comes out on Friday. Yeah, this could be a big week, actually, just in terms of expectations for the US jobs market.
If Doge starts to, well, I can't pronounce it how you like, can't you? Federal expenditure, then obviously US growth will fall because it's debt funded.
Yes.
And that is the trap, isn't it? That if you cut, of course, they're not actually planning on cutting their overall debt levels because they'll cut costs, but they'll cut taxes by more. So, I don't know. No change in many senses. It's just a redistribution.
Well, let's see what they do. But cutting thing is, if you cut federal expenditure, you're absolutely cutting spending. if you then give that money back through tax cuts, then a lot of that we know goes to the rich who will just
Yeah.
save it.
Yeah.
So, net net, let's see what happens.
Yeah. Agreed. Indeed, job postings index, unremarkable week.
Yeah, but it's still, you'd say drifting off, but there's been no dramatic deterioration,
No.
which frankly, I would have expected more of a reaction.
Mm. Wage growth steady around about 3%.
Yeah, perfectly compatible with 2% target.
And Link Up is continuing to report rapidly declining job openings in the US. So
Yeah,
that is looking bad for employment prospects.
yeah. I see, I've, this data is much more dynamic than
Mm.
the Indeed job posting data. You wonder how quickly, stale job postings
Yeah,
fall out of both.
yeah,
But this shows that Trump immediately having a bad effect on hiring. It's difficult to know which one to believe, but this one, the January spike followed fading again. That seems right to me.
yeah. Weekly GDP estimates from Dallas Fed 2.4%,
Yeah, perfectly good.
Atlanta Fed GDP now for quarter one down 1.5%.
Yes. Now, can I come in here, Richard? So
Yeah,
this has got quite a lot of comment online. I think they're messing up their calculation of
right.
GDP based on the surge in imports. There, because
Yeah,
imports subtract from GDP,
yeah,
the balance, then but I don't I think this is probably a one-off. And I think the underlying US GDP probably continues just fine. So I think the Atlanta Fed calculation is overreacting to the surge in imports.
yeah. Probably right, Keith. The New York Fed GDP now costs 2.9%, nearly 3%.
Yeah, still looking very nice.
Yeah, and the St. Louis Fed 1.5%.
Yeah.
The Economic Surprise Index at minus 16.5 at the moment. And US Trueflation is plummeted to 1.46%.
Yeah, that is seasonal. It's a year-on-year window effects.
Yeah. Then corporate capex is seeing a broad upturn, which is good for the US economy.
Yeah, absolutely.
And delinquency rates remain elevated on credit cards, which shows that the lower income consumers are still financially stressed.
Yes.
Elevated, but they've slightly flattened out, haven't they?
Well, I've got another chart coming up later, but yeah, because this is 30 days plus. You look at 90 days plus, it looks bad. So the people who
Right.
are really in trouble
Are
are in
getting
real
worse.
trouble.
Yeah. If the fiscal deficit is cut by 2-3%, then the private sector financial surplus falls, and you can't. There's no such thing as a free lunch in an
Yeah,
economy. So,
absolutely.
but it's very popular to cut the federal deficit, which is a sort of natural gut reaction, and the government's too big; it needs to cut. It needs to be
Yeah.
cut.
Well, I wish they'd cut the size of the government here, frankly.
Yeah,
And, we've talked many times about how entitlements. So everyone's moved on to disability benefits
yeah,
because they can.
yeah.
We need somebody actually needs to start enforcing the rules in this country.
So I was wryly amused today to read that the government is planning on introducing some sort of a fair employment agency to ensure that the new rules on employment contracts are enforced. Just at the time where they're saying there are too many regulators.
Yeah.
It's like these people, they do not understand
Mm,
the friction that they impose on economies.
absolutely. You should just set up a government website or whatever. There are these websites already where people can post reviews of companies
Yeah,
and let the market sort it out. If you're cheating your employees, they can, post on. just get the information out and you will be unable to continue doing that. That's the way the market works.
Yeah, I think that's a good idea, Keith. So Doge's estimated savings are annualized at 65 billion. And clearly there's a lot of fat in the US, in US government spending. There has to be with the amount that they're spending. Unfortunately, the problem here is 65 billion is a lot of money, absolutely. Relatively, it's a drop in the ocean.
Exactly. And unless they cut down on entitlements, they're going to get nowhere.
Yeah. And if they do succeed in making something like a 600 billion cut in spending, then it would be bad for the economy, which presumably would adjust it in due course, but good for disinflation.
Yeah.
And this is really, the fiscal deficit is out of control, remains out of control.
Yeah.
And of course, Biden did his best to screw everything just before he left.
Yeah.
That's my opinion.
Yeah. We've got, when we talk about the Byrd Rule, we talk about how he managed to do this.
And this is a chart, cumulative excess savings by income. So the top 10% of earners have masses of cumulative savings and are fairly flat on that, but the 90% of earners, basically, they have lost an awful lot of savings since the peak, although still above the pre-COVID level.
Yes, that's right. But of course, been eroded in value by 20%.
Yeah. The bottom 90% of earners are now responsible for only 50% of US consumer spending. And
yeah. So when we were talking earlier, Richard, about what happens if US cuts taxes, here, a lot of it is likely to be saved by the top 10%. But at the same time, the top 10% now are responsible for 50% of all consumer spending in the US. I find that absolutely astonishing.
Yeah.
Now, actually, as an aside, I was thinking about what Donald Trump is doing. And I think that the trouble with having billionaires running the country is the billionaires don't need society because they can opt out. So he is basically degrading society. And so you think they don't need the trains, they can take a private helicopter. They'd never see poor people. They don't care what happens to them. So he's basically degrading society, international society, because he doesn't care. What he wants is to cut taxes.
I'm reading The Art of the Deal.
Dear.
I'm only about a third of the way through it, but he does recount his childhood in that, and his parents' work ethic and so forth. So he doesn't come from that background. He doesn't come from a privileged background. Not unprivileged, not underprivileged. Doesn't come from a privileged background. And also, the problem with The Art of the Deal is it was written, I think, nearly 40 years ago. So you get a sense of who he was then. I'm actually not sure when it was written. I should just go and check the cover page. But it's an interesting window on the man, and I'm not, I want to finish the book and try and then sort of put the thing into context. I think he's a very hard man to understand. He does things that don't make sense.
Yeah.
It makes sense to him.
Well, you have to do a section on it when you've finished it, Richard.
We'll make those, Keith. So this is illegal immigration, and obviously it's collapsed, hasn't it, since Trump won the election?
Yeah.
So there's a summary, and I think we are just beginning to see Trump's policies impacting on the economy, and we are just beginning to see whether he really will impose those tariffs that he's been threatening in the next few weeks. And let's wait and see what happens.
Okay, thank you, Richard. No China section this week because there's no data, basically. Well, onto one chart. Now, I thought this was interesting. On the y-axis, you have the budget deficit as a percentage of GDP. On the x-axis, you have GDP growth per capita. And you'll see there's a good correlation between the two. The bigger your budget deficit, the better your GDP growth. Now, we're entering a period, hopefully, of fiscal consolidation in the UK. The bond markets are forcing fiscal consolidation. In Europe, France and Italy run ridiculous budget deficits, which they're having to cut. All that will mean growth coming down. The US, they're attempting to cut the deficit. If they do, growth will come down. All of that is bad for economic growth, which should be bad for equities, better for bonds, he says, as long as inflation comes down. But there's a great deal of uncertainty in the world, and frankly, what happens to the economy is probably not what is driving asset prices at the moment. You've seen what's happened to gold. The huge amount of political uncertainty is driving demand for safe havens, actually, mainly gold.
So what governments need to, because obviously, effectively what's happening with budget deficit growth is that future production is being drawn forward into the current year. And when you can no longer do that because government debt has reached unsustainable levels, then it has to either not increase or be reduced, which fiscal consolidation is reduction, isn't it? So the only way then to get growth is through productivity improvements.
Yes.
And all of these countries need to get to work on productivity improvements. It's the only way for economic well-being to improve.
Totally agree. And thankfully, Richard, we have a few things that could really help that in the pipeline. AI and robotics. But both of those, the robotics in particular, require vast amounts of capital spending. And that means interest rates need to come down. So anyway, let's see what happens.
Or return on your capital needs to go up. I mean, that would be
Yes.
the other way of achieving that.
Yeah, that's true. And on to the Byrd Rule. So, how does the US set a budget? We have seen this week that the House of Representatives has passed a budget, and there are various steps before the budget actually gets passed into law. And so far, only the House has passed the budget. It then needs to go through the Senate. And the budget they pass is only a blueprint. It doesn't actually get passed into law. That just defines the parameters for setting the budget. So sets the goals for federal spending, revenues, deficits, etc., and allocates resources towards the major functions of government. It is not law. It is non-binding and it is not sent to the president for signature. Now, each budget comes with a budget window, and that is the number of years to which the spending decisions will apply. Now, law requires the budget resolution cover at least 5 years, the coming year plus the next 4. But recently, the norm has been for a 10-year budget window, but that is not fixed. Previously, in the 70s and 80s, it was 6 to 7 years rather than 10. And they could revert to that. Now, every year, the budget writers have the option of including special instructions known as reconciliation instructions as part of the budget process, and these are quite powerful potentially. So normally, in order to get the budget through, you need 60 votes out of the 100 in the Senate. But reconciliation legislation can be passed by as few as 50 votes. And as the Republicans have 52 senators versus 48 with Democrats, if they were trying to pass a reconciliation vote, they could get that through. But Reconciliation cannot be used without the prior adoption of a budget resolution, and in particular, it's governed by the Byrd Rule, which places limits on the sort of legislation provisions that are subject to reconciliation legislation. So, what is the Byrd Rule? So, the Byrd Rule restricts what can be included in reconciliation legislation, and its core point is to remove extraneous items, i.e., pork barrel provisions. So, it's considered extraneous if it does not produce a change in outlays or revenues, increases the deficit beyond the budget window. Now, that is a really important provision. So, reminder that the budget window currently is 10 years. So, the Byrd Rule restricts reconciliation legislation from increasing the budget after the 10-year period. So that means that at the end of the budget window, the budget deficit should not increase. So that has meant in recent years, a lot of the budget resolutions have had a sunset clause, which means they expire within 10 years to avoid the prohibition against increasing deficits beyond the budget window. The 2001 tax cuts are an example of this. Now, there's another rule, pay-go. Now, pay-go requires that any new legislation that adds to the deficit must be fully offset by other spending or revenue changes, so the net effect of legislative changes is deficit neutral. Okay? Now, you'll be wondering, as I did, how on earth the Biden administration managed to massively increase the deficit given the pay-go rules. Well, two things. If you breach pay-go, then something called sequestration happens. So there should be automatic cuts to discretionary spending. But that excludes 96% of federal spending. So pay-go would only affect around 4% of spending. But in addition, the Biden administration interpreted pay-go to their own advantage. They essentially interpreted pay-go as being not legally binding, as not forcing agents to the government to actually implement pay-go offsets, only to discuss them. So hence, the Biden administration managed to get round pay-go and massively increase the deficit. Now, why does this all matter? So the Republicans have passed the budget resolution in the House, and in order to try and roll over the 2017 Tax Cuts Act, which would cost 4.6 trillion over the next decade and therefore violate the Byrd Rule, they're now talking about fudging it. Under the current law metric, tax cuts are slated to expire at the end of this year, but the Republican senators want to use a different scoring method called the current policy baseline, which would assume that extending the tax cuts costs zero because they're already law. So they're attempting to fudge it. Democrats are saying that the tactic would be, nuke the 60-vote filibuster rule and be very bad for, break all rules, basically. But the bottom line is, when you read all this, that both parties twist the rules to allow them to spend more money. And will the Trump administration be effective in avoiding the rules just as the Biden administration was? I suspect the answer is yes. And therefore, I think it's likely that Trump will somehow find a way to roll over the tax cuts. Your thoughts, Richard?
I'm sure They will, Keith. I'm sure it'll be contested and all sorts of argy-bargy and probably the Supreme Court and goodness knows what. But ultimately, I think it's going to be difficult to stop him from doing what he wants to do, particularly given his majorities. And I mean, there's still the only thing that's going to stop it, isn't it? Is if the market goes on strike, but even then the Fed steps in, and I don't think the market's going to go on strike, to be honest. So I suspect that he can actually basically do what he wants to do with this, although it'll take a lot of pushing and shoving to get it through.
Now, to be clear, if he rolls over the tax cuts, that will not mean the deficit gets worse. It will just mean it continues like this forever.
Yeah.
And onto the cyclically adjusted PE ratio. So we've been talking for the last year, I say for the last few years, about how expensive the US market is and how CAPE shows valuations are very high and the market is fundamentally overvalued. Now, what some criticisms of CAPE are that it doesn't account for changes in accounting standards. It just uses the average earnings over the last 10 years for the S&P without adjusting them in any way. It doesn't account for changes in real interest rates, which is absolutely true. And if there may have been a fundamental shift in valuation norms, we're skeptical about that one. Self-serving argument.
Yeah.
So how CAPE is calculated is you take the average real earnings of the S&P 500 over the past 10 years using the constituents at the time. So this is very easy to calculate because the data is already out there. The S&P reports average earnings all the time. But obviously, the actual number of constituents of the S&P 500 change all the time. And so when you do the historic earnings calculation, you're using the earnings from companies which have dropped out of the index. And you're failing to include the historic earnings of companies that have joined the index. So CAPE has a backward-looking bias. Now, what research affiliates have done is they've created current constituent CAPE, which attempts to adjust CAPE to eliminate that backward-looking bias by calculating the historic earnings of the current constituents of the S&P 500. And because has been recently a growth bias towards companies joining the S&P 500, current constituent CAPE tends to be higher than CAPE. So if you look at this chart, current constituent CAPE is the dark blue line. The CAPE, the Shiller calculation of CAPE, is the orange line. And you'll see that CC CAPE is higher than CAPE, but it was much higher during .com. So CC CAPE agrees that the market is very highly valued, but that it is nowhere near as highly valued as it was in .com or during actually the peak of the pandemic. And why this matters is that research affiliates claims that CC CAPE is better correlated with future returns than CAPE is. The correlation with 10-year head of returns is 0.62 for CC CAPE, but only 0.51 for CAPE. So they're claiming that CC CAPE is better at predicting the future than CAPE is. And they're saying that CC CAPE is more optimistic about future returns, equity returns, than is CAPE. See the table. So this previous periods where CC CAPE and CAPE are at similar levels to where they are today. I don't know what you think, but I'm rather unconvinced because this seems like special pleading. They're kind of trying to adjust CAPE to give a better answer.
Yeah, I was also struck that it might be, and the correlation 0.62 is not a particularly good correlation. And I was struck if you go back to the chart of showing the CC CAPE versus the other CAPE, it's at the peak, CC CAPE is much, much higher. But generally speaking, it's just a bit higher than
yeah.
CAPE. And I would say just, eyeballing that, it doesn't make it. I mean, I like research affiliates. They do some good stuff and they're very thoughtful. But I'm not sure that this is hugely useful. And what that suggests is that this bubble, in inverted commas, has got a long way to go to reach the dot-com bubble, much further than ordinary CAPE says.
Yes.
Maybe that's the takeaway. Maybe that's the takeaway from this. That if you go by CC CAPE, we're nowhere near the dot-com.
Yes, that's true. Yeah. Yeah.
But just go back to that chart again, Keith, if we may. Who's to say that actually the dot-com bubble isn't the outlier, and that therefore if you look at Black Monday, for example, who's to say which one is the outlier that's never going to be beaten? And we sort of have this mentality that everything always needs to be beaten before this time needs to be better, bigger, whatever. Well, maybe it doesn't need to be better and bigger. Maybe we've reached the peak, and then in future years we'll look back and say that was the peak of the 2024 bubble, or 2020 bubble.
Yeah, so I think all you can say is valuations are quite elevated.
Yeah.
But, it could keep on marching higher, but medium term, you'd expect equity returns to be not great from here.
I mean, I think fundamentally, if the US economy turns down, then the US market's going to turn down, isn't it?
Yeah.
And
I agree.
And that's that's the seminal, I think, unless there's some sort of catastrophe somewhere, that's the seminal event.
And on to US housing, Richard.
Thanks, Keith. I try not to make a habit of predicting too much where the market's going to go, because it's just impossible. So housing starts are stable, well down on their post-COVID highs, probably not surprising, and completions are running well ahead of starts. So the US housing market, in terms of activity, is looking strong.
Yeah.
House prices seem to be no longer rising, and the problem is that they've risen very, very sharply over the last few years, and they are too high to attract buyers. With mortgage rates remaining at 7%, which is interesting, isn't it? Because our mortgage rates, I think, you can get fixed rate now for about 4%. I know that the US is fixed over the term of the mortgage, whereas ours tend to be 3 or 5 years.
Yeah.
And the share prices of home builders have started to reflect a potentially poor outlook for the housing market and therefore for the economy. It's quite interesting, isn't it? Okay, so new homes for sale in the US. This is the highest it's been since 2005 or so.
Yeah.
But the building is still going on.
Yeah. So, I mean, when you look at the US housing market, it is mystifying in that, we've seen completions are running ahead of starts. And essentially, this is inventory. Inventory is rising. So why are the home builders still building so strongly?
I guess partly they build on hope, don't they? They've got the land, they've borrowed the money.
Yeah.
And they feel we have to build it out while we can, or we'll lose the funding. And once it's built, we build it out, we can get a return on it. I guess, so this is a chart showing the number of home pending sales that fall through. And actually, if you sort of take it was 2017, ignore COVID, right? 2017, 2022, pretty stable. From 2022 onwards, we got an upward trend. Not a steep trend, but a little bit of an upward trend.
Yeah.
First-time buyers are a record low of 24% of all home buyers, down from 50% in 2010, 40% in the early 2000s.
Yeah.
Big drop. And the median age, which we looked at before, has dropped effectively from sort of very early 30s. And then post-COVID, it's just gone bananas. And which shows that young people are finding it increasingly difficult to get onto the housing market ladder in the US, as they are in the UK.
So in order to be a first-time buyer, you now need to be pretty much in middle age. I mean,
but
shocking.
also there, Keith, with you and I don't know how old you were when you had your first child. I was 28. That would mean on average I'd be living in rented accommodation for 10 years.
Yeah, I was 31.
Yeah. So the US median housing payment as a percentage of median income has it's quite an interesting chart. So January 2006, it was 45%. Then it went through a big trough. Now it's back up to those sorts of levels.
Yes. So housing is as unaffordable as it was pre-GFC.
Yeah. Yes. So I mean, it is at a point where it is liable to a sharp drop, isn't it?
You'd hope so. Now, the thing is, there are loads of homes for sale.
Yeah.
So why aren't prices adjusting downwards?
Because the sellers don't need to sell for whatever reason, or they can't sell at these prices. They can't sell at a lower price.
Yeah.
Without going bust, and therefore, so median sale prices are still increasing over what they were 12 months ago.
Yeah.
So prices are still rising, and home buyers' housing payments are still rising as a 5.1% year on year.
Yeah.
So significantly increasing prices. Pending sales down year on year. I mean, there comes a point, doesn't it, where the market can't take anymore, and it looks like that point has been hit. And houses are taking longer to sell, and the average is now what is that? 56 days. It's not huge.
It's not huge. Yeah. But I mean, again, what you're seeing is sales weakness, but rising prices.
Yeah. And the home buyer demand index is falling, and I can see that's a green line for 2025. And construction employment continued to rise, as we've commented for the last couple of years. We've been surprised at this. It is slowly levelling off, isn't it? But it hasn't leveled off yet. 30-year mortgage rates remain at 7%, where they've been for the last 2 years. And so we don't really understand why the US housing market is so strong with such a low level of affordability.
Yeah, the thing is, what with the explanation we have given previously is this is due to the stock market. So people selling equities and then switching into the housing market. And if we now have a downturn in the equity market, then that would be very bad for the housing market. In addition, if the federal government starts laying people off, that's also bad for the housing market and just the economy in general. So the US housing market has been mystifyingly strong for a long time, but some of the props are beginning to weaken. So
I think that's right, Keith. I mean, we've been saying that this is unsustainable for 2 years now, and it has sustained. But it does look as if slowly it's unwinding.
Yeah. Okay. Now I did this on Friday.
Yes.
And so it's a quick and
you
then
can't keep up with the crypto market, Keith.
I can't. So, but we're going to go through this anyway. So top 10 cryptocurrencies, plus the Trump coin, they'd had, as of Friday afternoon, they were having a bad time. Okay. Compared to peak. I mean, some of these are big, Tron, Cardano down 80%, Trump down 85% from its peak. But then, as of last night, there was a bounce. So Bitcoin actually now down only 14%. Huge bounce. Ethereum down only 50%. Trump, instead of being down 85%, now down only 80%. And that means it was up 25%. Think of it that way.
So what is the implicit value in the Trump coin, Keith? This one's passed me by.
Well, it means you suck up to Donald Trump, So frankly, And what he's done just seems absolutely corrupt to me. What he's done is he has talked up a crypto reserve to prop up the prices of these things, including the Trump coin is up 25%. Now, there are no details. Is it just hot air?
Didn't someone in the UK get prosecuted for doing that a couple
Yeah.
of years ago?
Well, he's not president of the United States. So anyway, so this is Bitcoin on Friday, sharp drop down, then, bounce right back up, fading again a bit now. Ethereum, same, XRP, all big bounces. Again, big bounces, but, you'll notice, this is Dogecoin, that the bounces, most of them still well down from their peak. And it's difficult to reinflate a bubble, he says. Now, of course, if the Trump were to throw trillions of US dollars at this, he could get the prices up. But I don't know. Has there been a vibe shift? And are these things going to? Are we now actually going to have a deflation of the crypto bubble? This is the Trump coin as of Friday, down to 11.2 from its peak of 75. But then, that's a big move. That's like huge jump. And so this is as of last week, Joe Public was liquidating crypto positions. And if you had a leveraged crypto ETF, you got annihilated.
Oh, I like that name, T-Rex.
Yes. But, going back to our discussion of last week, one of the things I've got, if you just like these new things, you remember when Bitcoin was like $1? If I just stuck $1,000 in,
I know.
yeah.
If only.
If only, if only. So place your bets. I've got no idea what's going on. Is the crypto bubble finally bursting, or will Trump attempt to prop up crypto prices and the price of his own coin? I mean, I think that fundamentally what he's doing seems incredibly corrupt to me.
What amuses me, the only chart that I've only ever seen two charts that make sense in crypto. One is the chart, a log chart of the price against adoption.
Yeah.
And the other one is, I think it's the chart of the price against the federal deficit, the total QE that the Federal Reserve has done. But all other charts of crypto don't make any sense at all because it's so volatile.
Well, the thing is, Richard, there's an infinite number of these, like meme coins, etc.
Yeah, thousands of them.
Thousands of them. Most of them have, well, frankly, the whole sector, as far as I'm concerned, has got no intrinsic value. It's just a speculative asset. So if Trump can somehow persuade people there's an intangible benefit for buying the Trump coin, then, it can go through the roof.
But I think there might be a bit of intrinsic value in a few of them. But I think that intrinsic value has yet to be determined in real world use cases. And certainly the vast majority of them have no intrinsic value.
Yeah.
And I suspect that the intrinsic value of the few that will turn out to have it is not the value they're currently valued at, but it's less.
I've prepared a couple of sections we're not going to have time for today on again Japanese debt sustainability and also lessons from the Trump's tariffs in his first term. We'll do those next time, and I'll try and restrain myself from adding more special sections.
Okay, so having a look at Recession Watch now. So the yield curve just reinverted. Now I think it's the reinversion of the yield curve, which is the recession re-indicator, isn't it, Keith? Is that right?
Well, we kept on saying it's when it went positive. It was, it was meant to be when the yield curve was inverted. Then it was when the yield curve turned positive, and now it's when it's reinverted.
So basically,
historically it's worked, but then last time it spectacularly didn't work.
So now the yield curve is no longer an indicator of recession.
Well, where faith in it having gone to zero is just going back towards 100, you know. So anyway, we're reporting it.
So the SARM rule on the state level is the share of states with 3-month average unemployment rates 50 basis points above their 12-month low. And what we're seeing here is that the SARM rule is suggesting that there are some recessionary pressures indicators around, or it is a recession indicator. It hasn't
Yes.
reached those peaks yet, but it's undoubtedly moving up fairly strongly.
Well, absolutely. And if you think what Trump's doing, you know, he's firing loads of federal workers. They're not actually unemployed yet, but it's coming. Um, and he's cutting loads of contracts, which is going to hurt all the service companies. You know, the unemployment will almost certainly rise. I was walking, so I was reading about the US National Park Service and how he's walked in and just cut a load of people in the Park Service. This is
Yeah.
happening all over the US federal government. And so, in time, over the next few months, you're going to see a rise in unemployment and a great deal of uncertainty.
And this is the proportion of households living paycheck to paycheck, which rose 26%. Which rose to 26% in 2024, and there's a clear upward trend there.
Yeah. Yep.
Distribution of household wealth: bottom 50% of US households hold only 2.4% of total wealth.
Jesus Christ.
Wow,
It's
yeah.
really shocking.
And capital expenditure growth for the Mag 7 has been very, very strong, as we know, because we've been building all sorts of data centers, and obviously big areas invest a lot of money. But for the rest of the S&P, it's pretty weak.
Yeah.
It's positive, but it is weak. And corporate cash flow growth has been poor in the S&P 500X and Mag 7. And in Mag 7, it's been very strong, hasn't it? Although it is now declining. And Mag 7 is very cyclical. So that suggests that the capital expenditure by the non-Mag 7 S&P 500 is at, well, it's sort of recessionary levels, isn't it? And the Mag 7 declining.
So that basically, if we now get a downturn in tech, you know, that's another prop of the US economy being removed.
Yeah.
So basically, this is fast food sales in the US.
Yeah.
And you'll see that all the chains, actually, they're suffering sales falls, apart from Taco Bell, which apparently is really cheap. And what this shows is that poorer US consumers are cutting back on eating out, and they eat out at the cheapest places, but they're switching towards the really, really cheap place.
Yeah. And record months of US household borrowing on credit, credit cards and non-revolving loans.
That was for December, the last data point for December. But
yeah. And then you have the Q4 delinquency rates Keith referred to earlier that shows consumer credit stress is rising.
Yeah. So basically, this is 90-day plus, so it's serious delinquency. So haven't made a payment in 3 months, and you'll see that is continually rising. So the consumers who are in trouble are in deep trouble.
Yeah. Credit card interest rates remain towards their all-time high, and of course, with current delinquency rates rising, there's no incentive to lower these rates. Okay, so a bit of flight data. Number of European flights remains below the pre-COVID average.
Yeah, now I thought this was really interesting because we know that total number of flights worldwide is growing very strongly.
Yeah.
But in Europe, it's actually down. So this is further evidence that the European economy is really struggling.
Yeah. So the US, I mean, it's got K-shaped recovery. Trump is doing all sorts of things, chucking things up in the air, seeing where they land, and potentially eroding the social contract, although presumably all the government employees who voted for Trump are putting in their emails, "I've thank God that I voted for Trump," as one of their actions of the last week.
Yeah.
Yes, I mean, the whole thing has become terribly unpredictable.
Yeah. And on to other charts. So the UK continues to add renewable capacity. As Richard was talking about earlier, what we need is baseload. We need to invest in some nuclear reactors. But we're continuing to add wind and solar. And as we've talked about previously, we have contracted a load of new solar and wind at very high prices with subsidizing them through CFDs. And yet there's too much renewable capacity for the grid to cope with. So the amount of electricity curtailment, i.e., we are basically paying the generators to turn off because we can't deal with the excess electricity on windy days or windy and sunny days, has been growing. So
And bear in mind that our electricity bills reflect these payments.
yes,
So we're paying suppliers for supplying to us electricity that we can't use.
yeah, absolutely.
This is what happens when you get a government regulated market.
Yes, very true, Rich. And I was thinking, we did that section a few weeks ago on compressed air energy storage,
Oh yeah.
liquefied air energy storage. I was
Yeah.
thinking about what a total nonsense that was, because it could only provide around 12 hours of power. So, when you've got renewables like producing far too much electricity, you buy your electricity for very little. This 300 million pound liquefied air plant then liquefies air for produce energy storage. It then, when it's turned back on, it has 10 hours. But you know that when the wind stops blowing, it stops blowing for days, probably weeks. But
Yeah.
and so therefore, the net effect is you've added additional cost to the grid that it will be ineffective most of the time. You've just net added the cost. What you need is more base load that can provide power for 4 to 10 days, i.e., when the wind stops blowing.
I guess the point really here, Keith, is that we are creating a whole load of wind energy at the wrong time. And then we're saying, oh dear, what do we have to put in place so that this doesn't look quite as big a disaster as it really is? And then we spend a whole load of money putting something in place to be less of a disaster, rather than saying, let's stop polluting our coastlines, let's stop polluting our hillsides with these bloody things, and let's build baseload.
Yeah.
It's doctrinal, isn't it?
Well, it is. Yeah. Yeah.
And let's fill our farms, our arable land, our high quality arable land with solar panels. So Indian renewable energy electricity generation is growing rapidly.
It is. Although you'll notice that this is share rather than absolute numbers. And
Yes.
I suspect absolute coal use is still continuing to grow. They're still building coal-fired power stations, but it's good that renewables are growing.
Yeah. And they're not building hydroelectric power plants, presumably because they can't. They haven't got any more rivers that they can dam. Working age of the population is sub-Saharan Africa is the fastest growing working age population.
Yeah.
And China is the fastest falling working age population.
Exactly. And so over the last few decades, we've had massive benefits from globalization by adding all these cheap Chinese workers into the global economy. If we want globalization to continue, we need to start adding all these cheap African workers into the world economy.
Is this the price of orange juice? And
it is. This is the price, but it's absolute collapse. And what's really interesting is it's not collapsing because there's been any turnaround in the fundamentals. So we might remember that orange juice futures are really high because the Florida orange trees are suffering from a blight. And Valencia orange production is still forecast to fall by an additional 25% this year. What's happened is speculators have built a record long position, which they're then liquidating. And whenever you get, very large futures positions, they can unwind very quickly. So,
Mm.
although orange juice prices have come back down very sharply, the fundamentals are still not good, I'm afraid. And so you suspect that once this liquidation of futures is out of the way, they'll start rising again.
Looks as if, yes, this is a deep seek, isn't it? Etc. etc. AI is cheap and universally available.
Yeah, so they cut their pricing by 75% this week. So it looks to me like, AI is going to find it very difficult
To make money.
to
Sorry to interrupt. Yeah.
make a decent living.
And this is something we've talked about before, isn't it, Keith? That it's all very well valuing these companies incredibly highly, but actually, until you know what their return is going to be, it's a bit dangerous. And of course, these, they will compete with each other, and that means they have to spend a lot of money on research and development, and that their pricing is curtailed by their competition's pricing.
Yeah. It very much reminds me of all previous technology bubbles, like the railways. You know,
Yeah.
the railways in the UK. I mean, in the boom, there were the several railways between London and Bristol, and that's great. Yeah, while they're still building them, you can speculate on how much they're going to make. But actually, when the services came into fruition, then reality hit, and they
Yeah.
went bust.
Yeah. I agree.
And after all that, you need some good news. So here we are. The Swedes have been producing biochar. I thought this was really interesting, and they're doing it at a profit. So what you do is you take organic waste, and that is primarily striplings. So your fir tree plantations, you start off planting loads of trees, and then you have to take out some of them to where before they've grown to size to allow the other ones enough light to grow. And those are called striplings. And so what they're doing is they're taking these striplings and they're turning them to biochar. So what you do is you heat it up in an oxygen deprived atmosphere to around 250 C. And amazingly, doing that, you still release around 40% of the wood's latent energy. So this is a net energy positive process. And so you then create heat, which can be used to heat nearby homes, etc. And around 55% of the wood turns into biochar, which you can then use to enrich soils, and is that carbon is essentially captured permanently.
Hmm.
And there's a further 20% of the wood becomes pyrolysis oil, which is a heavy oil you can use in asphalt. And so the Swedes are doing this, and they're doing it profitably. And, that is proper carbon capture in
You,
action.
you do wonder if you could chuck a bit of plastic in there, actually, don't you, Keith? Because
Yeah, actually,
why,
that's a good idea.
that should degrade to
The
carbon
right
as
kind of
well.
plastic. Yeah,
Yeah.
absolutely. And on to markets data, starting with equities, Richard.
So a bad week basically for equities, but pretty much universally, apart from the FTSE All Share Index, which is up 1.1%. Everything else was down. Nasdaq down 3.5%. Bitcoin, as we've discussed, was down and very volatile. And the VIX was up substantially, up 9% for the week and up 12% for the year to date. And in
But
terms of year to date, the best performer is the Hang Seng at 15%.
yeah, but I mean, VIX is still not elevated. It's still,
No, it's not. So there's the FTSE All World Equity Index, the FTSE All Share Index.
yeah, had a good week. Keir Starmer getting us managing to get the UK to hopefully be avoiding US tariffs?
Just as a brief aside, Keir Starmer's criticised for not having charisma, but frankly, we've had far too many politicians with charisma who've messed everything up. And I'm quite happy to have one who could basically just do the job and doesn't care about charisma.
Yeah, well, I was very impressed with him, frankly. I thought he played that incredibly well.
Yeah, I think so. Euro stock 600.
Yeah, still up on the week.
Yeah.
Amazing, given everything that's happened.
Yeah, investors seem to be quite keen on Europe. The S&P 500, the Nasdaq, top.
Has the Nasdaq finally peaked? We've said this. I've said this so often. It's like I'm not saying it again.
The Russell 2000, which actually isn't doing very well, is it?
No, because that's right. The US economy is not doing well. And if Trump follows through on his threat to, well, cutting jobs, it's not going to be good for the US economy. And tariffs are not good for the US economy.
No. The Hang Seng, there's a topic which has actually been flat now for a year, hasn't it?
Yeah.
There's Bitcoin.
Yeah, look at that.
Very volatile.
Yeah.
And the pound against the dollar is slightly down for the week. The euro against the dollar is relatively strong still. There's the dollar index.
Yep.
And there's the VIX, as Keith said, it's not, although it's gone up significantly, it's not high by historic standards. And the American Association of Individual Investors reporting a near record spike in bearishness, only exceeded by, I think that's at Black Monday and the GFC.
Yeah.
But actually gets to that level-ish quite often, doesn't it? Not quite often, but more often than spikes above it.
Well, what's interesting is normally you see the spike in bearishness at the absolute bottom of a bear market. And now we're seeing it, when the S&P is only fallen 3%.
Yes, that's a good point, Keith. People are getting more twitchy.
Yeah.
The consumer confidence survey, in terms of stock prices, is, everyone thinks stock prices are still going to be higher in 12 months.
Yeah. So, I mean, there's been a drop. There's been quite a sharp drop, but people are still net bullish, basically.
And in historic terms, pretty net bullish.
Yeah.
The euphoriometer versus the S&P log scale. So, I don't know.
Well, basically, what they're saying, P ratios still remain incredibly high. VIX remains low.
S&P 500 earnings growth outlook. I find these charts that bounce up and down so fast very difficult to do anything with, really.
Well, no, I don't think it's bouncing up and down very fast, Rich, because this is a 40-year time scale.
Yeah,
so what it's saying is, earnings outlook way too optimistic. And I personally think that everyone's very optimistic about AI earnings. I think DeepSeek have just shown that AI earnings, apart from Nvidia, which may still go for a few years, but AI earnings are going to be illusory.
Yeah, no, I agree. I agree, Keith. So the bull market, investor credit, and the market inverted. So the red bars are, that's the red bars are the level of margin, is that right?
Exactly.
Which is a lot of margin, isn't it?
Yeah. So, if we've seen that the leveraged ETFs took a big hit on, Bitcoin ETFs took a big hit last week. If the market were to fall, you could see a cascade of deleveraging.
Yeah. Berkshire Hathaway's cash pile in billions. So apparently, I was reading an article over the weekend that said that Warren Buffett has historically been highly disrespectful of government debt as a holding, and yet he has 334 billion in cash. And the question that was being asked is, where is he putting this cash? And the speculation is some of it's going into precious metals.
Really?
The US stock market boom is not based on the strength of the economy, but on tech speculation. If you assume the strength of a good measure of economic strength is truck tonnage. Now, obviously, there's services to be included.
Yeah, absolutely. But if you look at like goods being moved around the US economy,
Yeah,
then it's
it's
down on
yeah,
pre-COVID levels.
it's reached a peak, hasn't it? People
Yeah.
don't need any more stuff.
Well, the thing is, the US consumers, the number of people in the US has grown substantially over that
Yeah,
period. We know because there are loads of illegal immigrants.
yeah.
So I suspect that is a good indicator of the general strength of the US economy, i.e., it ain't strong.
Yeah.
We've seen that, how the bottom half of the US population are just struggling.
That suggests, Keith, that the stock market should fall by about 60%, I think, in order to re-equilibrate.
Yeah. You heard it here first. Actually, you've heard it here for the last 3 years. But anyway.
We're bound to be right sometime, Keith.
Yeah. Well,
There we are. Earnings analysts, apart from Keith and my forecasts, are optimistic.
yeah. Just seems ridiculous to me. We'll wait and see.
And CTAs have been cutting their equity positions as markets fall.
Which
Well, the
is what they do.
markets haven't fallen very much yet, have they?
No,
I think
absolutely.
people are getting increasingly twitchy.
We'll see. They've hardly, yeah, nothing's happened so far.
All the big American equity indices have broken down through key moving average levels. And the Mag 7, as we know, have had a fantastic run.
They have. And so, when they said like a bad few weeks means nothing. Right.
And they've just touched their 200-day moving average, which they do from time to time.
Yeah. But fundamentally, I remain absolutely of the view they're ludicrously overvalued and they're investing huge amounts in AI.
The reason Keith is saying this because he's been buying the Mag 7 all the way up, and he wants to buy more, and he wants people to sell them so he can buy more.
If only that were true, Richard. If only that were true. And, congratulations to everyone who's ignored everything I've said the last few years and have done that.
The saying portfolio matters is actually a contrarian indicator.
I know. Yes. Like, there's that inverse Jim Cramer. There should be an inverse portfolio matters. That's like inverse T. That would actually be doing really well, sadly.
Analysts cut their quarter one earnings estimates by 3.5% so far this year, which is more than usual. And people getting wary, basically, aren't they?
Well, Trump is going to be bad for the US economy. I mean, he's cutting corporate contracts with the US government,
Yeah.
And onto commodities and generally downish. So energy down, industrial metals generally flat downish. Tin was down 7%, cobalt was up 7%, precious metals downish. Even gold had a bad week. So energy commodities, well, Brent continued to fall, down on the year now. European natural gas futures, great news, continue to fall, although frankly, I wonder whether they're getting ahead of themselves. They were assuming we're going to get gas flows from Russia. And although Trump is talking about settling the war in Ukraine, I see very little progress towards that. US natural gas futures also fell, but they're up 5% on the year. Coal continues to subside, down 20% on the year. Uranium had a small bounce, down 10% on the year. So this is Brent going nowhere. Its lows of the last 12 months. WTI similar. Some numbers specific to the oil market. Well, despite the weakness in the oil price, the US remains under supplied. So we've seen inventory draws since last week and over the course of the year so far. US crude production is basically stable at 13.5 million barrels a day, and the Baker Hughes rig count is pretty much stable. Now, the bottom line for the oil price is that OPEC has plenty of spare capacity. Look at the chart on the left. That's OPEC's spare capacity. It's got 4.5 million barrels. So they're threatening to release some oil onto the market. The oil price is already weak. If they were to do that, there would be further downside. This is EU natural gas futures. Great news for inflation. Come down, but it's still well up on this time last year. UK, same story. Now, thank you to Dan Leeds for sending me this. This is a big shale gas field that Egdon Resources have discovered beneath Lincolnshire, mainly under agricultural land. It contains 7 years worth of total UK consumption. So the big question is, will the government allow them to frack it? So Deloitte estimate that exploiting the Gainsborough Trough field would add up to $140 billion to UK GDP, yield 34 billion in direct taxation, create tens of thousands of jobs, and of course, having gas domestically produced rather than having to have it extracted in the US, liquefied, transferred across the Atlantic, then regasified in the UK, would save millions of tons of CO2. But do you think the government will allow them to exploit this field? I would bet you not.
I wonder whether they will, but not because this is in Ed Miliband's domain, I believe, isn't it?
Yeah.
Not because Ed Miliband is a clever guy, but because Starmer will overrule him.
Really? You see, I think even if they do give the go ahead, that it will take years of battling through the courts against environmentalists, etc. And then, even then, if they start fracking, there are likely to be mini earthquakes, and they'll have to loads of court action to try and stop them. I just think it's very difficult to get anything done in this country.
Yeah. I hope you're wrong, Keith.
Well, I hope I'm wrong, but frankly, I've lived in this country for 56 years. I kind of know what it's like. This is US natural gas futures down from their recent peak, but still well up. Coal collapsing. Uranium stabilizing.
Possibly.
I
mean, I think uranium's got a bright future personally, but it's definitely been hit over the last 12 months.
Industrial metals, Richard.
Thanks, Keith. So last week it was pretty quiet, generally speaking. Cobalt was up 7%. I don't know why.
No.
And tin was down 7%. Again, no particular reason. On the year to date, copper's up 13%, and neodymium was up 13%. Tin up 7% year to date, and cobalt's down 5% year to date. So basically, a bit of a mixed bag, I would say. But I don't know that there are any. Copper is the interesting one. I don't know why copper's moving so much. So there's aluminium.
Well, the thing is, copper is being distorted by the
by tariffs,
by threats of tariffs.
Yeah.
And actually, so when we were talking about the inverse portfolio matters ETF last week, we were talking about how cobalt was dead as a dodo because of this wall of copper coming out of DRC, and it promptly bounces by 7%. There you go.
So copper, iron ore, lithium, neodymium, nickel, tin, zinc, precious metals. We have all down last week, except rhodium. And so gold down 2.7%, silver 4%, platinum 3%, rhodium up 1%, palladium down 5.6%. Year to date, though, gold up, still up 9%, silver 8%, platinum 5.5%, rhodium 3%, and palladium 3%. So year to date, they're still strong.
Yep.
So there's gold, and the movement of gold to US is reputedly reflecting fears over the effects of impending tariffs, not fears about the sovereignty of London. That is the word that has been put out by the authorities. My view is that is not true. My
Ah.
view is that there is a physical squeeze on the COMEX and that they have had to desperately ship gold to the COMEX in order to be able to meet the physical demands.
Interesting.
And it's got nothing to do with tariffs, because I don't think Trump would put tariffs on gold. Why would he? So I think what is actually happening is there's a big physical squeeze. What
Right.
does Ollie Hansen say? Level of ignorance in this statement is astonishing. There we are. Transfer of signals, US weakness, reflecting market concerns about the COMEX exchange ability to function properly. No, I think Ollie Hansen is wrong.
Mm.
I know he's a bright guy, and I like
Okay.
this Ollie Hansen. I think he's wrong.
Okay. Right. So what's your prognosis then?
My prognosis is that there's continuing central bank and sovereign wealth fund and probably
Yeah.
large investor demand for physical gold, and that
Very good.
the demand for physical gold will continue and the price will continue to go up. That's my prognosis. That's one for the the inverse portfolio matters ETF, Keith, definitely. Which is now short gold, and
God. Well,
that's the price of silver, platinum,
going absolutely nowhere.
yeah, rhodium,
Going absolutely nowhere.
and palladium.
Same. Okay, thank you, Richard. On to rates. So, frankly, there's very little reason for bond yields in the UK to come down, because we've seen earlier that there's loads of inflationary pressures building in the UK. We've got loads of inflationary rises coming through in April, and the bottom line to me is wages. Wage growth is way too high. If wage growth was similar to the US, like 3%, UK would not have an inflation problem. And the fact that wages are so high, given the weakness of the labour market, frankly, just to me, clearly reflects government policy interfering in the labour market and raising the prices of wages for low-paid workers, etc., etc. US yield curve shifted down a bit. Now the 30-year is at 4.5% as opposed to 5.1 for the UK. So UK has a credibility problem still. Reminder, everyone is short long bonds. So the short interest in TLT is at a record level. If that were to unwind, that would cause a sharp drop in long bond yields. However, so on the hand, speculators are very short long bonds, but they're also very long call options. So basically, people betting on the extreme outcomes. UK 2-year, 4.2%, but the market not expecting the Bank of England to be able to cut rates much. 10-year, 4.5%, down from its peaks, but still high. 30-year, still above 5%. 30-year locking in restrictive interest rates in the UK for the next 30 years. US 10-year well down from recent highs. You'll notice that US 10-year has fallen a lot more than the UK one. German 10-year, so the market's thinking that UK has a problem with inflation. German 10-year, 2.4%. French, 3.2. You'll notice these haven't risen despite all the Trump shenanigans and threats that the deficits in Europe are going to have to rise to pay for defense spending. And this idea that they're going to do it by fudging it and creating a defense bank so that it will let the defense bank would lend all the European governments money, which would mean they wouldn't have to issue bonds. Well, it's still government debt. It still needs to be repaid. A very European solution, I thought.
Yeah, definitely.
There's
Pretend.
the Greek 10-year. Okay, concluding comment. This is the uncertainty index, just going through the roof. That's not good for anyone. It's been an absolutely extraordinary few years when we've been doing this podcast. And right now, Trump is being absolutely unpredictable. We just don't know. I mean, things like this, the crypto reserve, is that just an off-the-cuff remark? I mean, it's just like we just don't know what he's doing. There's no kind of
No idea.
substance to it.
No
You know,
idea.
the attack on the Zelensky this week, you know, undermining Ukrainian sovereignty, etc. You know, is he going to manage to negotiate a peace in Ukraine? There's a lot of noise, but actually, steps towards a ceasefire appear to be not happening. So, just a huge amount of uncertainty. And in that situation, gold is doing well. But frankly, I think that everything he's doing has to be bad for US economic growth. Actually, it needn't be good for bonds, which I'm very heavily long of, because actually what he's doing, raising tariffs, that will raise inflation, mean the Fed has to keep interest rates high. That's bad for economic growth. And he's cutting the deficit, bad for economic growth. So, you know, it looks to me like everywhere we're stuck in stagflation. Now,
Mm.
hopefully, medium term, inflation comes down and economies normalize. The Bank of England enforces its mandate. I think eventually that will happen. But in the meantime, I think we're in for a difficult time. And I think, you know, equities have been resilient. I wonder for how long that can continue. Richard, your thoughts?
Yeah, I completely agree, Keith. And I think the level of uncertainty is actually rising, not falling, as Trump sort of gets his feet under the table more because he's chucking more things around, and it's becoming really, really uncertain. And also, he's doing things which have very significant impact on the US economy.
Yeah.
But it's actually very hard to predict how it's all going to pan out. So, yeah, great deal of uncertainty. I think there is inflationary pressure around, particularly in the UK, as you say.
Mm.
And I think that there is a continuing sort of bifurcation, if you like, between BRICS and the US and Europe,
Mm.
BRICS and
Yeah.
China.
No, absolutely. And the UK economy has actually been remarkably resilient. Yeah. And avoiding Trump tariffs is a great thing. The question is he actually going to impose tariffs at all? I mean, they're meant to happen to actually tomorrow. It's the third. They're meant to start
Yeah,
happening tomorrow. I
yeah.
mean, we just don't know. And he's threatened tariffs on the the EU. Is he going to do that? We just don't know. There's so much uncertainty. Right. And on that cheery note, we'll see you in 2 weeks' time. Thank you for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye for Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.